good afternoon, everybody. Very, very warm welcome to today's webinar. My name is David Kellner. I'm a Managing Director at Numis. And firstly and above all, I hope you loved ones are staying safe and well. Obviously, amidst what's been such a difficult time for a lot of people, my thoughts are very much with those who are most affected at the moment. Quick word of introduction from me. I have the privilege of leading the Growth Capital Solutions team at Numis. And our goal is really to help the world's most ambitious private companies achieve their ambitions. And so our team delivers strategic advice, relationships and capital from global investors, as well as best-in-class transaction expertise to help growth stage companies thrive and scale. And in the last 12 months, we've helped some of Europe's most exciting private companies raise nearly $1 billion from long-term investors. And we're partnering with a really exciting range of disruptors to support them along their journey. For today's webinar, though, I'm absolutely delighted to welcome three of the world's leading investors in high growth companies: Harry Nelis, partner at Accel; Richard Watts, portfolio manager at Merian; and John Doran, general partner at TCV. Now, I'll ask folks to introduce themselves and their funds momentarily, but suffice to say, these firms have backed some of the most iconic and successful companies of our time, including Airbnb, Facebook, GraphCorp, the Hut Group, Klarna, Netflix, Spotify, TransferWise, Twilio. It's a real privilege to have their perspective, so a huge thanks to my guests. Now, I'm delighted that today we can talk about investing in the new normal. Obviously, COVID is reshaping and accelerating disruption in a way I think none of us quite anticipated. And as founders and investors try to position for success, understanding the reality of what's happening and what's to come has never been more important. So I thought we'd divide the hour today into three parts. We'll begin by exploring the reality of investment amidst COVID-19. Beyond the headline, how are activity levels and round dynamics and valuations changing through the pandemic? We'll then explore this new normal in which we find ourselves. How will the post-COVID world look different? What consequences will that have for consumers, for employees, for disruptive companies and investors? And then we'll focus squarely on advice for founders. How can founders best capture investors' attention and capital today? And what's separating the best founders from the rest as they prepare for the new normal? We'll finish with just a 5-minute quick-fire round in which we'll get our guests to agree or disagree with some reasonably punchy propositions. Ahead of the webinar, we've received dozens of your questions, so thank you for that. I'll be weaving those into the discussion as we go. And do feel free to submit questions during the webinar itself. Drop them with Capital Solutions team here at Numis. Email gcs@numis.com. That's gcs@numis.com, and we'll try to incorporate them. So without further ado, thank you sincerely to our guests. Thank you. There are hundreds of people on the line, so thank you for joining us. And perhaps can I ask each of our guests just to begin by telling us a bit about their firms and some of the unique strengths that they have. Harry, do you want to kick off?
Sure. Thank you, David. My name is Harry Nelis. I am a partner with Accel, based in London. Accel aims to kind of back and be the first backer of entrepreneurs who would like to build really large, iconic businesses. The way in which we can help these entrepreneurs is by being on the ground with them in wherever location they are based. We have offices in San Francisco, London, and Bangalore, India. But besides being on the ground locally, also providing them with a global radar screen so that they can see what's happening globally in technology. We have been doing this for the last 40 years in the United States, for the last 20 years in London, and have an approach that very much is focused on being sector specialists. So we have this internal thing that we call prepared mind initiatives, where we try and become really smart in particular areas, and then identify the companies that can make a real big difference there, and then invest in those kind of themes and those kind of companies.
Great stuff. Richard, do you want to do the honors next?
Yeah, thanks, David. Yeah, look, I suppose our background is a little bit different really to others. You know, our heritage at Merian, formerly Mutual, was in listed equities. particularly in UK mid and small cap. The desk has been running for around 20 years. Over that period of time, we've backed many growth investments. Names like Boohoo.com, Rightmove years ago, Just Eat, Auto Trader, and over the years we were getting increasingly frustrated that some of the most innovative, fastest growing companies that we were coming across were choosing to stay private. We often describe ourselves as probably the largest investors in IPOs in the UK. The desk size is around 6 billion AUM of assets, so we've cornerstoned many IPOs. And for us, it was a logical step really to actually go further than that and invest in companies whilst they were still private, if they were choosing to stay private for longer. And that really was where Chrysalis, the idea was born. We launched Chrysalis in November 2018. We raised about £400 million into that strategy. We've got 11 investments in the vehicle now, the likes of TransferWise, the Hut Group, McGrath, of course, Starling, Klarna, probably some of the better known names, I would say. And ultimately, I think our perspective is slightly different. We work very closely with these companies. I think we give them a different perspective. We come from the listed world, and I think we understand. We like to think that we understand very well, the expectations and requirements of investors in listed equity, and I think that perspective can be very valuable to these later stage private companies in particular.
Thanks, Richard. John?
Yeah, hi everyone. John Doran, I'm a general partner at TCV. TCV is a global investment firm. To position it relative to what you just heard, we're much later stage than what Harry mentioned. Think of us as kind of late stage venture, growth equity, and also majority deals. We focus really on three categories: enterprise software, internet, typically kind of marketplace type businesses, and fintech. What we're looking for is businesses that are category leaders, typically have big markets and substantial tailwinds. We will typically write larger investments. Our typical investment is somewhere between 75 and 150 million as a first investment, and we will double up and double down from there. We've often known to do a lot of crossover investing. So many of the businesses we'll back will ultimately go public. We've had about 62, 63 public offerings during our time. And we will, similar to what Richard just mentioned, we'll hold companies in the public markets for a very long time. So we've been on the board, involved with Netflix for 20 years. We've been involved for more than a decade with similar companies like Zillow, EA, Spotify, etc. So that's part of our model. And yeah, great to be here today.
Fantastic. So some really valuable and quite complementary perspectives here, which is particularly exciting. Let's make a start and discuss the reality of investing through the pandemic. In particular, maybe could you start by telling me a bit about how your investment activity has evolved through this? I know, you're going to say you're open for business, which is great, but is it fair to say that given allocation of time and capital to your portfolios, that the number of new companies you'll be able to back, perhaps in the rest of this year, will be a little bit lower than before, or are you seeing something different? So, John, do you want to start from a later stage perspective?
Yeah, I would say absolutely right in the sense that the crisis caught us by surprise, just the rapidity of it and how fast things changed. And so there was a lot of time in early March and throughout March, really understanding the impact on a company by company basis, doing some portfolio analysis across the portfolio, trying to make sure that companies had enough cash, trying to think about what the outlook would look like for the rest of the year, and really trying to get companies in a safe position to kind of weather this storm. In answering to your second part of your question, I don't think it means less dollars for deals in 2020, to be transparent. I think there are probably some practicalities that will make it harder. I think first and foremost, it does, maybe it's just what we're seeing, but it does feel like deal volumes are slightly down, just seeing less deal flow. I think it's probably harder to make new investments remotely in companies where you don't have a pre-existing relationship. I think that may change as we all get used to this new world, but I do think most of the deals that we still continue to look at are businesses that we've had a pre-existing relationship and know the companies well. And I think it'll probably be harder to kind of really build that rapport that you need to build with a manager team, with a CEO, remotely. I'm not saying it can't be done. I think it will be done. It'll be part of the new normal as we talk about. But I think that that will just take some more time and also probably learning some new skills on our side and also on the side of the entrepreneurs. The last thing I'll just say is, I think in times of uncertainty, there's always some caution on the side of the investment and the investment side. So we're looking to invest in category-leading businesses with great entrepreneurs and great, like I said, with big markets. Whether those companies are raising today, what the valuations look like, et cetera, is also something that we haven't really figured out. I think we'll figure it out over the next few months and years. But I don't see it as being I don't see it as us thinking about allocating less capital in 2020. It's just that if the opportunity is there, I think we'll go for it.
Got it. And Harry, you're unusual on the panel in having a dual focus both on earlier stage companies and on growth. Are you seeing a similar dynamic with earlier stage investments, or is there a bit of a divergence now between activity, earlier versus growth?
Our early stage activity is still very high, in fact. The interesting bit is that in the early stage, we invest more in people than we invest in companies. Companies, all, of course, are impacted by what's happening right now, but people, by and large, stay the same. So it's also important to note that some of the great companies today have been started in some really dark and difficult times. So what we try and do is we try and keep the pace and do the work that we all did before COVID, but have a bit of a different mindset. So especially with regards to getting to know people. So we, of course, pre-COVID, there was a premium to getting to know people in person. Instead, we rely much more on proper referencing. And one could argue that we should rely on proper referencing no matter what. And maybe we don't learn as much in in-person interactions as we think we do. So it still is perfectly possible for us to make investments in the way we did before, with proper referencing, with people who are referenceable. It becomes harder when people come from networks where we have less interaction and where it's just harder for us to reference people.
Got it. Richard, I'll come to you presently, but just to tie this off, in practical terms, just John and Harry, what does this mean for founders? Is it that when rubber hits the road, rounds take longer, it's tougher to meet a bar when you can't kick the tires in person, there's greater selectivity, or something different from that?
It very much depends on what sector you're in. There are, I think the crisis has kind of bifurcated the market in a certain sense between the haves and the have-nots. There are certain businesses who where the tailwinds have actually accelerated. If you think about areas such as remote collaboration or offline to online transition, like business models based on offline to online transitions, or telemedicine. I think those areas are really benefiting in this situation. And I think those rounds are super competitive, happen as quickly as they did before, at valuations as high as they did before. Then there's other areas where things have slowed down a bit because of the crisis. And I think those rounds will take longer, will probably happen at prices that are a bit lower or on par. Also, those companies may actually choose to delay their fundraisers to next year. So what I expect is that many companies who kind of realize 2020 is not going to be a great year for me. It may not be so easy to raise money in 2020. I think a lot of those companies probably reason we should reduce our burn, make it into 2021, and hope that the situation is better then. So I think right now in 2020, we're seeing the companies raising money who know that they can raise a lot of money quickly at high valuations. And then I think in 2021, I think we may see the companies who have been prudent enough to avoid 2020 for that reason.
And Richard, I mean, just picking up on that, how are you seeing kind of round structures and participation changing? Are kind of big front-footed, probably priced growth rounds still viable for the right company, you know, in this environment? Or is much of this year going to be about small convertibles, top-ups, and so on?
Yeah, look, David, I think the environment's actually changed very quickly. If you think of what we've done, we've been pretty active through this. We completed an investment in Feature Space, which we announced, 2 weeks ago. I honestly believe for great companies that are disrupting and competing in big markets, where there's just a very strong natural growth drivers here. I think those companies are every bit as desirable, if not more desirable today than they would have been, even at the start of the year. I think the reality is, everywhere you look, I think the channel shift towards, digital businesses, online businesses has been accelerated. And we can see this, in listed equities and in the private businesses that we own. And I think the market has recognized this very quickly. So I think for those kind of assets, I think the demand will be great. I kind of think about this in probably three areas really. When you think about cash burn, so those companies with a very pressing requirement for capital, I think there is an opportunity there to negotiate valuations down versus what would have been previous expectations. I think the market is still active. There are probably some players that have sat back a little bit. Once they kind of assess the shape and condition of their portfolio, the requirements of the companies that they're investing in. So I think there is an opportunity for high cash burning companies to negotiate valuations lower. But the reality is most best-in-class businesses, I don't really see valuation being impacted greatly at all. So I think what also might change here is, companies and founders, it's crucial to partner with the right people. And I think this is what this environment might remind people of, is that ultimately, it's going to be a choice sometimes between valuation and choosing the right partner. When I say the right partner, people that can help businesses, with strategy, but also with capital and further, capital, who've got big balance sheets themselves to deploy, to support a company through its growth. So, I think that's going to be increasingly important going forward.
We'll obviously talk about the new normal in a moment, but collectively, if and how have your selection criteria changed in light of COVID? Are you leaning to kind of different sectors and themes, or is it more around prioritizing companies with different kinds of characteristics, say capital efficiency over growth or otherwise? So are you prioritizing different things? John, do you want to?
Yeah, sure. I would say it's been a bit of a mix. I would say what the crisis has done, I think Harry alluded to it earlier, and there's been a lot written about this. It's accelerated, I think, accelerated the changes that we've been trying to invest behind. And so I think about things like telemedicine, for example, which Harry mentioned. I think that type of transition from offline to something like that, I think we're only going to see an acceleration. I think things like banking and payments, digital payments, will equally see an acceleration. So for us, as a typically later stage investor, some of the themes that we've been tracking, which we probably thought were opportunities we're going to see or really get deep on in 21, 22, I think is probably going to happen earlier. So for me, it's really about I don't think there's kind of new themes per se. Maybe there are at the edge, but the themes remain the same. It's just that the opportunity, I think, is possibly bigger, but also is here now earlier for us to try to invest behind. I think another category that we've always struggled with has been the kind of the last mile delivery area. And I think part of the reason we struggled with it was because of unit economics and things of that nature. But, I think you have to put your hands up and say COVID-19 has changed the game for those companies dramatically. And so I think that we'll probably see some big winners emerge. We've already seen some, business that look like they're winning, but I think you'll see some real big winners emerge as a result of that.
Well, that segues very nicely, actually, to think a bit about the new normal and kind of what's changed. Maybe, Harry, let's start with you. What long-term change are you most confident that COVID will drive, and how is that kind of changing your?
I think the trend that we've been investing behind for several years now, really in the enterprise sector, really has been digital transformation. At the end of the day, every company will have to be an Amazon in their own area because it's a requirement. Every company today, whether you're in the shoe business or the travel business, you will become a software company, which means that you need to transform all the processes that you use today. And I think what's happened in the last 2 months, we probably have seen in the last 2 months digital transformation worth a couple of years. That whole process has become much stronger, and I'm absolutely convinced that will continue to happen. So in enterprises across any kind of vertical, whether it's oil and gas, finance, manufacturing, that's a trend that we have been investing behind with companies such as UiPath in robotic process automation, or Celonis in the case of process mining. And I'm absolutely convinced that trend will continue for many years to come.
Richard, from your perspective, what behaviours, what new behaviours that we see do you think will be permanent, and which will revert to kind of pre-COVID norm?
I'm not sure really, because when I think about it, I mean, this digital transformation, and like in our view, and I think we're seeing it. I think this is the biggest channel shift in the history of the internet, quite simply. Pretty much every online business or digital business that we look at is seeing strong growth in new users and new customers, because frankly, consumer behavior has been changed. People are being forced to go to these online businesses or digital businesses. And we kind of think about this a lot, because we've got a lot of businesses that are rooted in the old world or the old economy. And look, I think the reality is it's a big channel shift. In time things will settle down. Look at the businesses that have been impacted, travel businesses, for instance. Do I fully believe that people will travel around less? I think probably for work. Yeah, I think doing Zoom. Everyone's using Zoom or Google Hangouts, whatever it might be, but video conferencing. So I think behaviour there will change quite significantly. Or has been changed significantly, and I think that carries on. That travel for leisure purposes, I expect that to come back more quickly. So I think it's going to be a real mixed bag. But I think where behaviour's been changed and people understand that the new things that they've been trying are better than how people used to do things before. I think that would be more of a permanent shift.
John, from your perspective, again, what kind of things do you see as being kind of one-way doors in terms of behaviour shifts versus maybe areas where people have got a little over their skis in terms of extrapolating for long term?
I mean, you make a good point. I do think the tendency is to extrapolate for the long term, overly so. That said, I think what I would agree with everything that Harry and Richard have said. I think if you're not we have this, one of our themes is kind of acceleration of everything in the cloud. If you don't have your data and business applications in the cloud before this, I think very certain you will. You will be working on that and making sure that's the case. I think work from home, I kind of see benefits to being in the office, quite frankly. I think if I think about this business, if I think about being an accountant or a lawyer, many professions, I think there's a big part of that, the apprenticeship model, like learning from superiors, learning from people that are more experienced than you. So I think that we will see people going back to the office in large numbers. But looking at it from just what I'm hearing within our organization and also within our portfolio, I do think the people are taking a second look at the amount of travel they've done, especially business travel, and can you do a video conference, a Zoom call or a Google call instead. That said, I would caution against that. If I think about it, in a world that's competitive, and if you are a CRO at an enterprise software company, or you're kind of scrapping it out, trying to take away market share from some of the big incumbents, will you try to get in front of customers to meet people face to face? I was going to say press the flesh, but obviously in this environment that is is no longer the case. But being in the same room with somebody and really building that kind of rapport, if that can win you the deal, then I think it's going to be hard for other people not to do it, right? They'll just lose the deals over time. So I do think it's hard to extrapolate, but there's definitely some changes. I think business travel, I personally think people will be, they've seen how easy things are with Zoom, and they will change that behavior somewhat. Or I also think about, for example, in our own house, I think a lot of people have gone online with groceries, and they're like, after you use it for a while, like, well, hold on a sec, why have I, once you make that shift, that offline to online shift, which Harry was talking about, whether it's groceries or payments, whatever, you kind of ask yourself, why would I go back? So I think some people will, but I think a number of people won't. And so I think those things will be permanent, but it's very hard, as you said, to extrapolate long-term, like nobody knows.
I think you make a very good point on the work from home bit and the travel bit. I think working from home is very easy when everybody's working from home.
Yeah,
I think it becomes much harder if part of the company's working from home and the rest is in the office. So right now we're not really in a realistic scenario, because right now everybody's working from home.
Yeah, I heard the same thing, Harry, with Zoom calls. So, for example, one of the things I've noticed with board meetings have been really efficient. They start on time, they're very filled with content, and then they kind of end much earlier. But if you think forward to your point, if 3 or 4 people are in the room, and then you're one of the guys on the Zoom call, it works. It's a different dynamic to everybody being on the Zoom call. And so it'll be interesting to see how that plays out.
Another way, sort of human behavior and motivations are harder to change in the long term.
Yeah.
Got it. Richard, do you think, I mean, I'm generalizing here, but kind of a lot of companies will become really remote first, or is it eating away at the edges of it?
When you say remote, sort of in a sense of working
from home, as standard, or
yeah, I think what this has done is open companies' eyes to the possibility that they can just change the way they work, and it doesn't mean that they don't have offices anymore, but it might mean that they can have less office space. It might also mean that they can have office locations that are in cheaper areas outside of London, for instance. And I think ultimately, what we see with our investments is, they were built in the cloud. So those businesses naturally work very well, to remote working, and largely they've not missed a beat. This is, I suppose, probably the more stressed environment that a company can operate through. Suddenly shifting and having pretty much your whole employee base working remotely, and lots of companies have sailed through this because they've been built that way. So, look, I think it will change. Like, I don't want to overplay it. I think the reality is when people can go back to the office, I think behaviour will change again. But I think a lot of what we've seen will prove to be permanent. I think people work from home a lot more. So you might go into the office 3 days a week. You probably work from home, 1 or 2 days a week. So again, I think, look, we've got investments in real estate, and we think about this a lot, in terms of demand for office space. So look, I think there is going to be a change, but the longer this goes on, then the more permanent those changes become, I think. And look, the lockdown is now, but look, let's just see where we are at the end of the year.
Yeah. Harry, what do you think is most misunderstood about the new normal that we're going into?
Who are you addressing the question to, David?
To yourself.
Okay, I think what's most misunderstood is that nobody knows. I mean, anybody who's telling us what the new normal is honestly cannot know. So, and there's so many cognitive biases that play into what you think the new normal is. I think that the best position that you can adopt is nobody knows. And in the same way as there can be an outlier event on the negative, and by the way, I mean, many smart, the guy who, I forget his name now, who coined the term the black swan is very upset because...
Yeah.
Yes, he's very upset because he says people are referring to COVID as the black swan, and if there ever was a white swan, it's COVID. So it's a bit of a distraction, but many unexpected bad things can happen, but many unexpected good things can happen as well, and we're just biased in how we think about these good or bad things given the situation that we are in right now. So I think the best attitude to adopt is we don't know, and it's okay.
Of the areas where does seem to be a direct travel, so a bit of remote working, really great digitization, health, last mile delivery, etc. What do you think the kind of secondary consequences will be of those becoming more popular? I read something earlier that it's a little distraction, but it was talking about how organ donation had declined because there had been so much less travel that fortunately people had fewer accidents, but it had meant that it was quite challenging for people on a waiting list. And that sort of, I didn't even begin to think about those kind of tertiary implications of all of this. And I'm just curious to, are there any areas where you see sort of quite strong second order implications from what we're seeing?
I think the first one is, I think in the UK, I think the high street will be changed forever. I cannot imagine how the high street is gonna not change. And again, I hope it's going to be for the better, but there will be a period of transition. I cannot imagine how independent retailers, small independent retailers can survive this, or restaurants can survive this for a prolonged period of time. So I think a lot of them will go out of business, and something will come back instead of it. I just don't know how. And when. We may go through a long period where we're kind of in the middle and it doesn't look so nice.
John, what about yourself? What do you see happening?
The question is, what do I think? What are the secondary effects that I see that are? To be honest with you, I don't really know. I feel I'm totally in Harry's camp when he said nobody knows. I think there's probably a number of known unknowns, which Harry you've described, which is there's what the outcome of what happens in the high street, or what will happen to real estate, but residential and commercial. Richard made a good point. I think even though I do think people will go back to the office, I don't think it'll be the same where everyone needs to have a desk. It'll be more, I think it'll be more, much more streamlined in that sense. I'm already seeing CEOs in our portfolio talk about that. I do think you have fully distributed workforces in some companies. We've seen that. I think that'll become more popular. I think the residential side, if I just think about, Harry, you mentioned, I think living around London, for example, there's always been important to be close to the high street.
We've just got an interruption on his
you know, get your coffee or get from preference perspective. There's probably a bunch of unknown unknowns, like things we just haven't thought about that I don't think we can think about, that it will really only play out over the course of the next number of years, depending on how this gets resolved, which I don't have a good view on right now.
Richard, I guess sort of picking up on that, I guess getting off that, if the one thing we can all agree on is that we don't really know, and that we're in a time of unprecedented lack of visibility, how does that affect your investment decision making? So, you know, are there themes or success factors that are attractive to you, or you know, what's more or less?
Yeah, look, I agree with the view that we don't really know. I think there are some things that we know though, and you know, look, I think what feels very clear to us is this whole, you know, channel shift, digitization, and the transition to a digital economy, and I think that has been accelerating, and that, you know, that will continue. So I think for us, you know, I think there are lots of consequences of this really. When, you know, you think about how we point the high street, you know, a third of high street stores today in the UK, or before the pandemic, were loss-making, and those stores, you know, they weren't viable anyway. And what this has done is really accelerate their demise. And, you know, that means that, you know, the channel shift to online has to be permanent, okay? Because those stores, you know, just won't reopen in many cases. So that would be permanent. I think things like business transformation as well, where you look at many verticals and categories, you know, like I think about beauty. And, you know, we've been investing in the Hut Group. But if you look at the beauty category, you know, big brands like L'Oreal and Estee Lauder, only about 10% of their sales are online. And, you know, if you're those businesses, you know, the reality is you've got no idea if, you know, another coronavirus comes along, you know, looking to get second wave or third wave, or we get a new virus in 2 or 3 years' time. So I suspect if you're sitting in a boardroom of, you know, one of those companies, you're going to be looking at your business and how you engage and sell to the consumer channels that you go through. And I think business transformation is going to be a big because, you know, companies have to future-proof them. You can't be in this position again, quite frankly. So, you know, we think about the banking sector, kind of similar to the high street, but, you know, the big banks in the UK, they probably spent the last 10 years, you know, ripping out, you know, the service counters, and essentially having, you know, bank employees walking around the branch with, you know, iPads and, you know, sofas and that type of stuff. You know, is that going to be the same? You know, do you want to go to a bank branch and tap on an iPad when lots of other people have been doing the same thing? So I think, again, you know, the banking sector is going to have to change. So I think lots of these things, you know, to us, the problem won't clear. Well, it's not we accept it being clear and certain, but I think there are a number of areas that seem quite clear to us.
Got it. And just before we move on, Harry, what themes or success factors are most kind of attractive to you at the moment? Kind of live with this uncertainty, but see what's unfolding.
Yeah, we have been investing heavily on the enterprise side. So typically we have 2 sectors that we are involved in, the consumer side or the enterprise side. We've been focused mostly on the enterprise side. And we're spending a lot of time in pretty specific areas. For example, within security, we are spending a lot of time in authentication and authorization. So subsectors, we are spending a lot of time in DevOps, in the developer operations and security subsectors. So it's pretty, and again, our approach there is to try and get to know entrepreneurs early, spend time with them, and back them at that point. So one constant as well that I forgot to mention is there will always be great entrepreneurs. So no matter how bad the economic environment will be, there will always be great entrepreneurs, and it's our mission just to find them early and start work with them.
And John, you mentioned last mile delivery as an area of interest and so on. Are there other themes or characteristics that are particularly attractive to you right now?
Yeah, I think some of the ones that Harry mentioned are very interesting to us. I think on the consumer health side, we think is interesting, not just telehealth, but wellness, education. Education, I think, is going to be massively changed, potentially because of this. You think about just universities, both here in the US, if people are going to remote, what are they actually paying for? I think that's something that will change. We'll see some changing. I would say on the digital entertainment side, we've already seen a big impact in streaming with the likes of Netflix or Spotify. I think we'll see more change there. On the video game side, esports side, the impact on sports, I think will be pretty big. I think Harry mentioned automation. That's a big theme for us. Augmenting workforces, allowing them to do more from home, driving kind of towards developer productivity, developer tools is another area. And then I would say the thing we talked about already, if you are working from home and if you are at home, I think in-home spend is going to go up, right? So at TCV, I think I mentioned, some of our biggest investments are Netflix, Spotify, Peloton, EA. All of those four have kind of benefited. We've had other ones that haven't benefited, so I'm not trying to they're just the success stories. But I think those, people are going to be at home more until there's a solution here. And I think that the spend there will continue to increase. And I think that there will be some behavior that will change. Maybe, not to backtrack once earlier, while we don't know the outcome here, I think it's inevitable some behavior will change. And we think that's within the home spend, that'll be a big area. So there are some of the themes that we're looking at.
And I think of that latter point, it's kind of the rise of the home economy, if you like. It's one way to put it. Yeah. Okay. There's lots of founders on the line. It would be great to give some perspective for them in particular. What do you think is most misunderstood by founders in the current environment? Say, Harry.
It's a hard question because I don't think there are many misunderstandings about now versus before. If there were a misunderstanding, namely it's hard to get financing today, that is not true. I mean, we're eager to back great entrepreneurs and help them help them build great businesses, and we realize that it doesn't matter what kind of economic environment you start in. And we realize it's typically a 10-year journey. So if that misunderstanding were to exist, I would like to dispel it and say, no, we're open for business.
And Richard, from the kind of other end of the scale, particularly with an eye on public markets as well, are you seeing any disconnects in the conversations you're having?
I don't think we've seen any disconnects. I think, look, it's very interesting. I mean, obviously, founders are very entrepreneurial people. And I think the reality is history has taught us that, disruption gets accelerated through recessions. And, what we've been very keen to do is to support, businesses and founders to recognize that there's a real opportunity here to kind of accelerate their business models, and because they're very disruptive in nature anyway. And I've got to say, I think the investors that we're in, I think, they've seen the opportunity, and I obviously don't want to diminish the the human tragedy of the pandemic, but from a business perspective, there was an opportunity here to accelerate these business models and their growth, and I think we've been very pleased that the founders that we're involved with, have recognised that, and and I think just in terms of disconnect, I kind of think it's really easy. I think it was very apparent, in this environment that, raising capital in the private world, whilst there's been a lot of capital around, and it has been easier, the reality is, in times of crisis, and let's face it, March was a time of crisis, and really part of April was a time of crisis. It was hard for some companies to raise capital. And I think whilst we're sitting here today feeling that life, for some of these companies is a lot better and there's a lot easier to raise capital, ultimately you might not turn out this way. This pandemic has accelerated the trends that were in place. Companies generally are performing well. But ultimately, I think if you're a big company that might have been thinking about IPO maybe in 3 years' time, maybe thoughts around that are actually do it earlier. Because what's very clear, if you're a publicly listed company, it is so much easier and so much quicker to raise capital when you need it.
Got it. And John, how do you think founders can best attract investors' attention and capital today amid such a tumultuous environment?
I actually don't think it changes. I'm kind of in the same camp Harry had mentioned. I think it's about, I think for the great companies that are doing well despite this, I think it's continue to do what you're doing, focus on the product, building a great team, and taking market share. Even for companies and I think there's some great companies that have been hit for six with COVID, right? I mean, there's some really interesting travel companies that no matter how good an operator you are, you've just, it's been a very, very difficult situation. In that situation, I think in those type of companies, and it's not just travel, I think there's a lot, hospitality, etc. I kind of, not to go back to what Richard said, but it is an opportunity, a crisis is an opportunity, and it's very hard to make wholesale changes with a business that you have always wanted to make while you're driving 100 miles an hour. And so I think the ability to kind of really dig in on the engine of the product during this period can also be an opportunity. I also think everybody agrees on this call, I've heard it said many times, if you look at the crisis of 2001, dot-com bubble burst, and then the global financial crisis of 708, some great companies came out of there, not just the ones we all know, but there's a long list. And I think the ones that can get through this with enough cash and with a great product will go on to thrive. But that's my perspective on it.
And Harry, as we move from the flatten phase of the pandemic to the kind of fight phase of the response, what behaviours are you seeing from the best founders that maybe separates them from the rest?
What amazes me in the best founders is the speed with which they can make decisions, and the accuracy and the amount of good decisions that they have ended up taking. So the best founders are the ones who can take difficult decision rapidly and come out ahead. And we've seen it. I've seen that again in this period where many people just stood up to the challenge and made some really hard decisions, but that I think at this moment in time still look like the right ones. So it shows you that everything depends on the right kind of founder, and if you're backing a great founder, they can steer the ship through even difficult times like this.
John, from your perspective, what sort of founder behaviours are you seeing among the very best? That's maybe
I think it's exactly that. I would add a couple of things. I think speed, no question. The great founders tend to be very data-driven, and this has been one where it's hard because the data, things move so fast. No matter how data-driven you are, you didn't see it in the underlying business. But still, I think speed is very, very important. Decisiveness, very, very important. What I would say I've noticed is, and I see this, actually there's been founders I've disagreed with and I've turned out to be wrong, is that founders tend to have the really good founders have a great way of blocking out the noise, right? They really have to focus on what matters. It's their business, it's their baby. And so they hear all this kind of noise that's on the side, but they're able to kind of really channel and focus to make those decisions, which are possibly tough calls Harry mentioned, or even to disagree with others around the board who may have a different perspective. I do think that that is something that I've seen. It's kind of a mix between blocking at the noise and like an independent view of where things are going, and not just following kind of the kind of groupthink around the table. That to me has been something that I've noticed over the course. I think time will tell whether people are right there. It's still too early to say that you are. We're 2 months in. I would actually challenge one thing you said, Richard, is I still think we're kind of in a crisis personally. I think we're kind of in a relatively benign period during that crisis. But to me, the lockdown may not be as severe, but the full solution here and outcomes we're no closer to, as far as I can see it. It's not quite, well, it's just not quite clear in my mind. So I do think the jury's out on that stuff, but I do think that the founders that have really impressed me have been, reacted quickly, been decisive, and just being able to block out a lot of the noise that's been surrounding this whole kind of crisis.
Should the very best companies be using this window to raise capital to press competitive advantage, or do you think that's often not the right approach? Maybe Harry, do you want to say that?
I think many people are doing so. I think the interesting it's John and I have a joint experience here. So there are companies where the investment thesis was offline to online transition, and with the lockdown, sometimes the offline solution was not available, right? Because we were on lockdown. So suddenly a whole bunch of customers who used to go to the offline solution now have to look for an online solution. So in scenarios like that, it makes ultimate sense to invest more and try and acquire those users who now suddenly are looking for an online solution. So there's many situations like that where it makes ultimate sense to invest now in customer acquisition, etc., because we're at a unique point in time.
Yeah, Richard, what do you?
I think that's exactly our view as well. This is a period of time for many of these businesses that it might not be here in 3 months or 6 months. The opportunity could be gone, and I think it depends on the nature of the business. Whether it's a capital consumptive business model, but I mean, ultimately, it's the right thing to do, and we use the right thing to do for companies to come and raise some money to accelerate, the pace of growth in an environment that is going to potentially may only last 6 months, 9 months, whatever the time period could be. I think we're absolutely the right thing to do.
And just lastly, because we're beginning to get to the end of our time, but just Richard, in particular, you've got an interesting perspective on this. Public markets are, should we say, more resilient than I think many would have thought. What impact is that having, do you think, private market activity and some of the dynamics that we're seeing around that?
Yeah, look, we were arguing this back in March, and we it's very interesting. I mean, typically recessions are reasonably long, drawn out affairs. The GFC was 15, 18 months played out, and the reality is when you're in that environment, you never really quite know where the bottom is, and so you tend to find that equity markets, or equity markets, they basically share prices track earnings declines. And so if you look at the GFC, from peak to trough, earnings fell 50 to 60%, and the market was down about 50. I think this time our view was very different because it was very fast down. The fastest fall, deepest recession in history. But likewise, I want to take on board John's point. We wouldn't really know if we come out of this, but I think it's clear that the second half economic activity, or certainly Q3, is going to be better dramatically than in Q2. And what you've seen, obviously, with listed equities is, significant government and central bank support, and obviously you've seen the reaction, right, with stock markets. They've recovered very, very strongly from the lows, and You know, you would never have thought that US markets would basically flat to modestly up. You know, if someone told you at the start of the year that you're going to have the biggest recession in history, and would the US market be flat, you know, you wouldn't have believed them. But the reality is, it's happened so quickly, and so people have looked through, you know, the recessionary impact, and they're trying to look towards recovery. Now, this could be a false storm, or it's roll over again. But you know what it does mean, if this does persist, you know, it means that we've got the winners in the stock market. We all know who the winners are. I mean, you know, it's Amazon, it's Netflix, it's Spotify. You know, our private businesses look more like those companies than they do, you know, the old world companies that have bore most of the brunt of the market action. And I think ultimately, I think my thoughts on this is going to change from where I was at the end of March, you know, to where I am now. I think for the best-in-class private businesses that have navigated the pandemic very, very strongly, you know, this will be something that those companies can point to when they decide to list. Say, actually, we've been tested in the worst recession in history, and we came through with flying colours. And if you're one of those businesses, I think the reality is the stock market would be prepared to pay a very, very high valuation multiple. So I think from my perspective, in the UK in particular, there aren't many companies that look like that are listed. Where we do have them, you know, names like Boohoo.com, for instance, you know, the train line, you know, Espo Capital, which is like a digital media business. You know, share prices have been great, and so I think, you know, ultimately, you know, we might find that some of these private businesses, you know, particularly the bigger ones that have been private for a long time and again quite large, you know, this could actually accelerate their idea around an IPO.
It's fascinating. Thank you. We are pretty much at time. Just a minute or two left. Could I just finish with our quick fire round? Just 1 or 2 word answers each, please, if I may. A few propositions to put to you. Agree or disagree? There will be an economic depression in the coming year.
Disagree.
No idea.
Don't know.
Agree or disagree? Major stock markets are highly overvalued.
Disagree.
I will answer the rest of the questions. This one I still don't know. I'm not a public market specialist, so I just say long term we'll know.
Harry?
Disagree.
Okay. Agree or disagree? In time, corporate travel will rebound to, let's say, within 20% of pre-COVID levels.
In the long term, yes.
Yeah, I agree with that.
I agree.
Agree or disagree? Government's responses to COVID have generally been sensible.
Personally, I disagree.
Agree. Hard job all around, but I agree. Very hard, difficult position.
Aaron?
Joining you from the United States, disagree.
Yeah.
And penultimately, agree or disagree? For many, remote working will become the permanent default post-COVID.
I agree with that.
Agree.
Disagree.
And finally, bit of fun. The first thing I will do post-lockdown will be
go to the office.
Go to the pub.
Go out for dinner.
so some breadth in the economy to look forward to. Super. I think that's our time today. Gents, a very sincere thank you. It's been fascinating to get your perspective on those areas. Some points, as I would have expected, some surprises, and you know, very much the richer for it. So thank you, Harry from Accel. Huge thanks, Richard from Merian, John Doran. Very much appreciate your time. Thank you very much, and we'll certainly follow up and share notes and recordings of this with everyone. But hope everyone stays safe. Get in touch if we can help with anything, and thank you all.
Thanks.
Bye.
Bye-bye.
Bye-bye.
Bye.